Hello and welcome again. And if you are thinking about implementing a new project or a solution, you would like to know first an indication of how profitable this solution would be. If you have a project with different alternative, you would prefer knowing some indication which alternative is more profitable to go for. To evaluate an opportunity or a project, there are several methods to do that. In this chapter, we are going to discuss 5 of them, starting from net present value, payback period and the discounted payback period, internal rate of return, return on investment, and finally, minimum accepted rate of return, also known as hurdle rate. Also, we are going to discuss the pros and cons of each one of them and when it's more suitable to use. Let's start with the first one, net present value or NPV. NPV is an evaluation method which is commonly used to differentiate between two available alternatives and to help you decide which one to choose. Again, as we agreed multiple times during this course, money in the present worth more than the same amount in the future. And in order to evaluate any opportunity properly, it's really important to know the present value of any future profits. Let's have an example to explain the concept. And let's say you are planning for buying a new machine for your assembly line, and the budget you allocated for this machine is 10,000 US dollar. And it's expected that having this machine will get you some profits over the next 5 years in form of producing more products, or this new machine would consume less energy and producing more products. So before purchasing this machine, you and your team concluded that buying this machine will get you approximate annual profits for the next 5 years. Here is during planning, you found out if you pay 10,000 US dollar for the next 5 years, you will get this 5 payments or 5 profits cash flows over the next 5 years. And now it's time for decision. If we paid this 10,000 US dollar and having this expecting incomes for the next 5 years, would this be a profitable decision to buy the machine or not? The challenge here, as we know, that these future values or future profits worth less than their present value. For example, this 3,000 US dollar, you will get it from a year from now, worth less than 3,000 if you have it right now. That's where NPV method comes to help you to calculate the value of each one of these future profits in today's value. So what we are going to do right now is to calculate individually the present value of each one of these 5 cash flows that we are going to get in the future, then sum all of them together to the initial cost, which is 10,000 US dollar. Technically, it's not going to be summing it, we are going to sum this present value to the negative value of this 10,000 US dollar, because this 10,000 US dollar not a profit, it's something we paid. So when we adding to the present value, it should be in negative sign. Don't worry, we are going to go to the calculation together to explain it further more. For this example, we will consider a discount rate of 6%, and usually this discount rate is decided based on how you are getting your funding. If you are getting a loan with interest rate of 7%, then this 7% is going to be your discount rate. Or if you have a shareholders that expecting 10% return on their investment, then this 10% will often be your discount rate. Let's start calculating by having the present value of each cash flow using this formula. Basically, it's the formula of having present value for single future cash flow. Here is, we have our CFD, and here is the number. And before we start, again to before starting, please note that we will not calculate the present value for the initial 10,000 US dollar, because there is no point of calculating a present value for something we are going to have it or pay it right now. It's already in the present. No point of calculating present value for it. And again, it's in negative because it's not a profit. It's something we paid or invested. Profits, it's having a positive sign because it's something incoming to our company, but 10,000 US dollar is negative because it's something we paid to buy this machine. After the calculation, we found that the NPV is equal to 4,382 and 15 cents. Good. But what actually this 4,382 and 15 cents means to us? What indication NPV gives us in this case? Actually, it means that if you paid or invested this 10,000 US dollar in buying this machine with this expected 5 inflows, then you will get a profit of 4,382 US dollar discounted to the present value. And of course, the asset itself. So after 5 years of paying 10,000 US dollar to purchase this machine, you will get 4,382 US dollar as a discounted present value plus the asset itself. Another indication that a positive net present value indicates that the summation of all present values of future profits exceeds the initial investment. In our case, all profits exceeded the initial 10,000 US dollar investment. We can generalize that any positive NPV is a good sign of profitability, and an investment with a negative NPV will be a loss. Means that only investment with positive NPV value should be considered. But what about if you have a project with 2 alternatives and 2 of them having a positive NPV? Then the alternative with higher positive NPV is going to be the more favorable option to choose. As you may have noticed, NPV is mainly based on assumption and estimation, such as assuming the discount rate percentage and estimating the future profits and expected expenses. In previous example, in case of the machine, you will need an operator for this machine with salary, maintenance fees, insurance fees, spare parts, energy bills, and so on. And you should estimate all of that during your analysis, which make NPV has its risk due to the unforeseen expenses which were not taken into consideration during the analysis.